Stock represents ownership in a company. Each unit is called a share. Owning 50% of YouTube's stock means owning half of YouTube. Shareholder, someone who owns stock. Stock exchange, place where investors can buy or sell stocks. Public company, a company whose ownership is organized via shares of stock that are intended to be freely traded on a stock exchange. Bull market, bear market. A bull market is when prices are rising, while a bear market is when prices are falling. Volatility, how fast the stock price moves up and down. Volume, number of shares of a company traded each day. Capital, broad term describing anything that gives value to its owners, usually money, but also includes machinery, patents, etc. Liquidity, how easily you can get into and out of a stock. It increases with volume. Bubble, occurs when prices for an item rise far above its real value due to too much optimism, followed by a dramatic fall. IPO, initial public offering, when a private company becomes publicly traded to raise money. Dividends, portion of a company's earnings paid to stockholders. Not all companies pay dividends. Blue chip stocks, stocks from well-known, established companies with a strong history of performance and often paying dividends. Forex, foreign exchange, involves trading different currencies. Portfolio, collection of investments owned by an investor. Holdings, contents of a portfolio. Interest, the extra cash paid on a loan. Bond, when an investor gives a loan to a company or government earning interest. Security, tradable financial instruments such as stocks and bonds. Broker, person or platform that buys and sells stocks for investors, usually for a fee. Going long, betting that a stock's price will increase. Asset, resource with economic value that is owned or controlled, expected to provide a future benefit. Commodity, basic goods interchangeable between producers such as grains, gold, oil, and natural gas. Yield, earnings from an investment. PV ratio, price to earnings ratio. Tool used to determine a stock's valuation. Can be misleading as past or projected earnings may not hold. Index, method to track the performance of a group of assets such as the S&P 500. Futures, contracts obligating parties to buy or sell an asset at a predetermined future date and price. Options, contracts giving buyers the right but not the obligation to buy or sell an asset at an agreed-upon price and date. ETFs, exchange-traded funds, baskets of stocks that trade like regular stocks. Can be passively or actively managed. IRAs, individual retirement accounts, long-term savings accounts with tax advantages for individuals with earned income. Liability, something a person or company owes. Penny stocks, shares valued at less than $5, considered highly risky. Market cap, refers to how much a company is worth as determined by the stock market. Leverage, using borrowed money to invest, increasing potential returns and risks. Balance sheet, financial statement reporting a company's assets, liabilities, and shareholder equity at a specific point in time. Inflation, a rise in prices, translating to the decline of purchasing power over time. Bid, the highest price a beer is willing to pay. Ask, the lowest price a seller is willing to sell. Bid-ask spread, the amount by which the ask price exceeds the bid price, which must be resolved before a transaction can take place. Black swan, slang for an unforeseen and unexpected event. Dead cat bounce, temporary recovery of a stock price from a prolonged decline followed by further decline. Whales, investors or corporations with large capital that can make waves in the market. Unicorns, startups valued at $1 billion or more, named for their rarity. To the moon, slang for a stock rising in price rapidly. Tanking, the opposite of to the moon. Stocks depreciating in value significantly and quickly. Jigged out? When a market moves into an unfavorable position, causing a trade to be closed only for the market to rally later. Pump and dump. Fraud involving artificially inflating the price of a stock through false statements to sell it at a higher price. Rug pull, a pump and dump in new, small cryptocurrencies, usually done by their creators. Panic selling, widespread sell-off due to fear, causing prices to decrease further. Shorting, investment strategy speculating on the decline of a stock's price, involving borrowing and selling shares to buy back later at a lower price. Short squeeze, when a stock's price unexpectedly increases, forcing short sellers to buy back shares at higher prices, further driving up the price. Limit order, order to buy or sell a stock at a specific price or better. Stop-loss order, order placed to buy or sell a stock once it reaches a certain price to limit losses. Long squeeze, similar to a short squeeze but affects those going long, often triggered by stop-loss orders and panic selling. Market order, order to buy or sell a stock at the best available price, ensuring execution but not a specific price. Good till cancelled order, order to buy or sell stock that lasts until completed or cancelled. Day order, order to buy or sell a stock at a specific price, expiring at the end of the trading day if not completed. Averaging down, strategy of purchasing more stocks when the price drops to decrease the average purchase price. Fading, trader deliberately going against market sentiment or trends. Hedge fund, limited partnership of private investors managed by professionals using risky strategies for high returns. Mutual fund, pooled assets from shareholders to invest in stocks operated by professional managers to produce gains for investors. Control stock, shares owned by major shareholders exerting significant influence over a company. Holding company, business that holds controlling stock in other companies but doesn't produce or sell anything itself. Swing trading, medium-paced trading strategy with trades lasting from days to months, aiming to profit from anticipated price moves. Intrinsic value, measure of an asset's worth, usually different from its current market price. Book value, theoretical value of a business if all assets were sold and debts paid. Price-to-book ratio compares a stock's market price to its book value. Value investing, strategy of picking stocks trading for less than their intrinsic or book value, often due to market overreactions. Growth investing, investing in young companies with expected above-average earnings growth, offering better returns but more risk. Earnings per share indicates how much money a company makes per share by dividing net profit by the number of common shares outstanding. Technical analysis, trading strategy analyzing statistical trends to identify trading opportunities. Fundamental analysis, analyzing a company's actual factors like competitors, management effectiveness, and industry state to identify trading opportunities. Efficient market hypothesis, hypothesis that share prices reflect all available information, making it impossible to consistently beat the market. Supply and demand. Supply is the quantity of a good available, while demand is the quantity people want. Prices rise if demand is high and supply is low, and fall if the reverse is true. Insider trading, illegal trading based on non-public information from company insiders. Ticker symbol, abbreviation uniquely identifying publicly traded companies. Compound interest, earning interest on both the original investment and the accumulated interest, creating exponential growth over time. Profit margin, percentage of profit a company makes from its revenue after subtracting costs. Dollar cost averaging, investing a fixed amount of money at regular intervals, regardless of price, to reduce the impact of volatility. Return on investment, measure of profit or loss made on an investment relative to its cost.